Good morning, Sense of Things. It's Jeff and Ron here for the last Sense of Things show of the year. This is it's either we'll call it our predictions or contrition show, talking about our
Yes.
predictions for the year, as well as what we're predicting for next year and talking a little bit about what's going on in the market. So that's what we're going to cover today. So stay tuned and we will be back on in just a second. Hey, everybody. Welcome to the show. Ron, how are you doing, my friend?
Morning. Good morning. I can't believe this is our last show and twisted my arm and put me in a headlock almost 2 years ago to convince me to do the show. So it's been fun. It's something I didn't expect. I've been enjoying it and getting good feedback. And actually, this is, believe it or not, despite all the fun we've had over the last 18 plus months, actually longer than that, I love this the best because you put everything together for the year and then you think about next year and what, not necessarily what went wrong, but what didn't we expect and what we got right. It's so unpredictable. No crystal ball, no magic 8 ball.
Yeah. I think for me, it's the first time I'd ever done anything like this, doing this kind of prediction stuff, because I typically don't. But I look at it as it's a way to share with my clients and the audience my thoughts on this. And I think it's the good part for you and I, it's our own unique thoughts and ideas and our coverage that we have.
Yeah, but don't forget, you got clients asking you all the time, well, what do you think's going to happen? Where do you think it's going? And we have an idea. Typically, on most years, if you say up, you're going to be right 75% of the time. There's always concerns. There's always headwinds.
Mm-hmm. Yeah, and I think everybody has this kind of belief, oh, next year is going to be amazing. But there's a lot of, I think you're already seeing it with this whole thing going on with the debt ceiling and everything else. It's just not everybody's on kumbaya mode.
And we have infighting.
Yeah, you got infighting within the conservative side of the house and everything else. And it's, yes, things are going to move somewhat quickly next year, but don't put it past Congress to completely screw that up and be fighting into.
Of course not. Of course not. All right, you ready?
Long ways to go. All right, why don't we kick off and where are we going to start?
Why not just start without being any religiously specific? Why not just wish everybody a happy Festivus every day?
I think that's completely right. I cannot wait for the airing of grievances. We do have the Festivus poll already set up in the office and at home.
Absolutely. And let's not forget George's portrait of Happy Festivus. And just because we need to combine a couple of things with Festivus, and of course, Elf has to wish Happy Festivus to the rest of us.
Good God.
And why not? And why not?
That Buddy Elf just needs to go away, man.
I talked about Elf the last couple of times. And look, there's going to be two staples over the next week. It's going to be A Christmas Story, as we both know.
Yes.
And it's certainly going to be Elf at any point. So why not? Why not?
And Christmas Vacation. Do not forget that.
Absolutely. Oh, absolutely not. That's all good. All good. All right, here we go. So I brought this slide up probably about a month ago. 314 Research does a really good job. And when they brought this up, I don't even think the S&P had hit 6,000 yet.
Mm-hmm.
But this is 7,000 by the end of 2020, by 2026. So within the next year. And when we get to all the price targets and have all of our fun fodder, this was October 14th. This is not just realistic, but on the top end or on the top average of most of the targets. So let's get into it. So last year, you and I were way off. So here we are as of the end of the close yesterday, which we had a 3% down day yesterday. Yeah. 58, you were the closest. So guess what? The price is right for you.
Ooh, I was only off by about 12%. But other than that.
So why don't we just, I'll let you make a quick comment. I'll make a quick comment. Yeah. Do you remember why you said the high end was 52.62 and what shocked you the most that we're at 58.72?
The way I looked at it was going into this last year, knowing that we were going to be in a presidential election and knowing that it was going to be a defecation show, to say it the least. I truly expected the economy to start giving up a little bit. What has shocked me about the economy, and I think we've both had this conversation over the last couple of shows. What has shocked me is the resilience of employment in this country.
Number one.
People are not in a good position when it comes to their finances right now. I think part of this was that during the pandemic, we had historic savings because the government was throwing money at us. Like
Right.
every couple months, we'd get a check from the government for Uncle Joe's, little check from the government or whatever. And all of a sudden we had all this extra money that had been saved up. We weren't traveling and everything else. So I think people built up nice savings that they've rapidly depleted over the last 3 years. And now they're working into credit cards, but they still have jobs and they're still able to pay the bills. The retail numbers are through the roof.
We're spending.
Yeah, it's just crazy. So that, I think, is the biggest surprise for me. I expected a lot less. My bear case was more rosy than yours, but I expected to be closer to the base case this year and never thought my bullish case would be anywhere close.
Yeah. And I think what I was looking at was around an 8 to a 10% rise, which was around the average. And we'll talk about that in a minute for next year. But we just saw so many
Yeah.
look, about a year ago that, hey, if you take a look at my bear case, that was
Yeah.
almost a 15% pullback, 20% pullback.
Yeah.
And a lot of these market strategists that they come out and said, look, we were wrong this year, but it doesn't mean that data was wrong. And I
Mhm.
get that. And that's a strong argument
Yeah.
because look, employment was strong. That's the number one factor. I 100% agree with you because
Mhm.
people have money, they're spending, they have paychecks. So they're at least able to pay off the minimum balance. But credit card carryover debt from month to month is 1.2 trillion.
Yeah. And rising. Yeah.
Oh, it's not going down. And the average interest rate on that is now above 22%. I think it's closer to 24%.
Mhm.
So these banks and credit cards know something.
Yeah.
They're not extending credit lines. And I know this is a separate conversation. So that kind of went into my whole theory that I'd rather be more conservative to the upside. But if I
Yeah.
pull back, we pull back. So for
Yeah. And
20, even though we hit 6,100 in the last week, we're at 58.72 and we got a little bit of an up morning so far. I'm looking at around 10% upside, 8 to 10%
Mhm.
upside. But the interesting thing is that many of the market strategists are looking at a 14 or a 15% upside in earnings next year.
Mhm.
Now, depending on where the 10-year and the interest rates are and wherever, that the earnings may get affected because we have so many multinational companies. If the dollar goes up, we're not going to be exporting as much. So I
Mhm.
thought 10% was about right. The base case, 6 to 8%, whatever, terrific. But I actually took a much more of a right turn on the bear case because
Mm.
I'm thinking if we're down, we're going to be down. And I'm looking at
Yeah.
15 to 20% on the downside. So that's why I was much more, the floor's got to drop. If the floor's got to drop out, the floor's got to drop out. And even though everybody's excited about less regulation and whatever, we'll talk about them when we get to the sectors. I
Mhm.
just feel as if there's a geopolitical incident or if one of these freaking cracks finally separates, enough that I think the downside is going to be more precipitous. So that was how I'm defending my numbers. How about your numbers?
Yeah. For my numbers for next year, I looked at, and once again, we'll cover this in some of the sector pieces of it, but I look at two major factors affecting the world next year. One is the reduced regulations, I think are going to help out a lot, especially in certain industry. The finance industry and the banking industry is a great example of this. The multi billions of dollars that are spent just on compliance on some of these things,
Oh,
some of that can get removed. That's just bottom line for these companies. The other piece of it is tax reform. And even if nothing changes, it's a good thing because otherwise, January 2026, it goes through the roof back up again. And I think we have
They'll
a
get something
lot
done.
of, yeah, no, they're going to have to they will. But once again, I don't put it past, okay, we've got all Republican across the board. I don't put it past them to be complete and utter doofuses and fight infighting and all this, because you have some people that basically they want the government to spend no money. And you have people that are like, we have to be more practical about this. And there's somebody, and there's very little in between, or very little in the middle, that I think we're going to see some infighting, and where we would hope that we got some tax work done early in the year. I think, as they're doing with the debt ceiling right now, they don't do anything until the deadline's looming, and then they just scramble around at the last second, regardless of what side is in
Yeah.
charge. So,
But historically, when one political party
yeah,
controls all three, the market doesn't do as well.
yeah, yeah.
So I realize people think the infamous this time it's different,
This time it's
but
different.
but historically, if you're playing the odds and we're not traders and we're not trading our clients' money, historically things go down. And look, we've had 2 double-digit years, and I just wrote about this in my newsletter for next quarter, that if we have 3 double-digit years, the 4th year is typically not a good year, and we saw that in 2022.
Yeah.
So we shall see.
Yeah. So the only thing I will say that is different this time around is, although we have a president who's having another term, it is completely different from what we've ever experienced, because typically that second term, the president kind of phones it in a little bit, and you've got a president coming back in who knows the job and can get things started quick. And it seems like he's getting some things started quick, and he's got energy going into this and he's got basically just 4 years to do it. So I think that, from my perspective, that's what gave me a little bit more feeling of positive for this year. So my case is, my bear case is that we're only up 4 or 5% for the
Yeah.
year. My bull case is somewhere around 17 to 18%.
Yeah,
And
you're on the high end. Yeah.
yeah, my base case is around 12. My cases across the board are that we will have a positive year. It's just, I don't know how much at that point. I don't know what to expect going into this. Like I said, there's a lot of stuff that has to happen this next year, and it's going to be interesting to see.
I got you. Okay, let's move on. So I'll let you defend your sectors to
Okay.
avoid, and then we'll talk about ones to consider.
Yeah. Mine, utilities, although we're going to get less restrictions and things like that, I think there's a lot of infrastructure build.
Had a hell of a year in utilities.
Huh?
Had a hell of a year in utilities.
Oh, it was an amazing year, and it's largely because of interest rates dropping. There's a lot of build out that has to happen in the utilities field that is going to cost a lot of money. I've always been a big fan of NextEra Energy. It had been a core position in our portfolios, and it did horribly this last year, largely because they're in Florida and Georgia. So they've got a ton of rebuild that they have to do, but the amount of money that is going to have to be spent over the next 10 years to rebuild our electric grid to be able to withstand the
Oh,
power of AI is insane. I was just listening. I picked up breakfast and I was listening, and they were talking about there's multiple startups in the nuclear space to build these little small nuclear reactors specifically for data centers. And
they haven't built a new nuclear plant from scratch in over 30, 35 years, something
yeah,
like that.
yeah. I think Comanche Peak was one of the last ones here in Texas. And basically, Comanche Peak runs 90% of North Texas in one plant. So that's all of Dallas, Fort Worth, all of basically North Texas is run by one nuke plant. Yeah. And I think that one went online when I was probably in high school, beginning of high school. So like 83, something like that.
Okay, talk about consumer staples. Why don't you
Consumer
like that for
staples,
next year?
I really don't like it because I think we're still going to have, I think people are still going to want toothpaste and all that, but I think it's going to become an after run. I think it's going to be one of those ones that people just don't focus on, and they focus on other areas in the market.
Okay. All right. So I have never been an energy bull ever. Is when clients come to me, I say there's three things that I don't get involved in and I don't recommend. One of them is energy because it's too pegged to oil. And if you look at oil, it's only been in a downslide for the last couple of years. But
Yep.
if you take a look, and we do have a chart on this a little bit later about the sector performance over the last 15 years, on average, energy is in the bottom half of the performers every
Most of the
single year.
time.
And I
Yep.
realize a lot of these energy companies are diversified in natural gas and other things.
Mm.
I just don't see energy doing well. Think about this too, and I'll move on. Look at everything that's going on in the world between China, Russia, the Middle East, and oil is not over $100. It's around
Mhm.
$70 a barrel.
Yeah.
Is that? Now, I know we've been producing more in the United States. I just look at this sector to avoid. Now, you mentioned Nextera Energy, not as a recommendation, but just to look at.
Mhm.
I am sure some of the energy companies will do very well on more on the electrical side, if you want to consider them. I know it's a utility. Some of these energy companies and utilities play off of each other.
Yeah.
So that's why I don't like that. Real estate. Now, real estate shocked the hell out of me the last couple of years with the home builders. But what I didn't realize and I learned pretty quickly is a lot of the home builders do their own financing. So they
Mhm.
were able to control and offer some unbelievable incentives to get their houses sold. I think that run is over for a little while because if you look at it, Fed rate cut three times this year, a total of one full basis point. And the 30-year fix didn't move all that much this year, if you look
Mhm.
on the average.
Yeah.
The 10-year is now over 4.5, headed to 5. So why is the Fed rate going down and the 10-year going up, right? They should be a little bit more correlated, but I think but that'll tell you still how much fear there is in the market in the world. And then
Mhm.
financials. I am bucking the trend here because a lot of market strategists love financials. Listen, I think the banking industry, which is another one that I do not invest in, is a huge black box.
Mhm.
They're all about, you've heard this before, NIM, NIM, net interest margin. Guess what? They couldn't make a darn penny on that for 10 years where interest rates were at zero. And now that interest rates flew up in the last couple of years, they're still not making money.
Mhm.
Right? They're making money on all the other banking services that are out there. Not only that too, but I saw a great chart by Carter Braxton Word looking since the financial crisis, the banking sector, the money centers are one of the worst performing sectors relative to the S&P for the last 15 years.
Mhm.
So even if they have a good year next year, who cares? They've underperformed the market. A long-winded way of saying I am going against, because a lot of people like financials going
Yeah.
into next year. I do not. Okay. How about your sectors to consider? We're similar on a couple, so I'll let you talk about yours.
Yeah.
Well, I'll tell you what, you do one, I'll do one.
Okay. Why don't I take the first one? Healthcare. Healthcare was absolutely atrocious this year. I expect the first half of next year for healthcare to be, specifically the healthcare companies and the pharmacy benefit, uh, whatever they are. I think they're going to struggle a little bit next year because the new president coming in, as he's extremely focused on this. And I'm looking at 2016 as an example. He was going to come in and do a whole bunch of stuff with the Congress about Obamacare and everything else, and nothing really got done with that. So if you looked at the 2016 numbers, the first half of the year were terrible, and then it took off. So I'm playing the odds on that, that I think that's going to continue. I think it's probably going to repeat itself from that position. Technology, we are in a fourth industrial revolution with AI and everything else. So I still think technology is going to be good. It may shift around and the players may shift around a little bit. We saw this, 2 weeks ago with Alphabet coming out with a chip that literally is it's
Right.
it insane what this thing can do. It can
Yeah.
produce or it can handle calculations on such a level that it even could put some issues into cryptocurrency and things like that because it can analyze data so fast. It can break those encryptions, which is not a good thing.
Right. We're a generation away from that being usable. All right.
Yeah.
Real quick, let me go back and then we'll go back and forth. So
Go
I
ahead.
agree with you on healthcare and biotech, but my reasons are a little bit different. First of all, it's been an underperforming sector the last 2 years. And
Mhm.
we have the chart, we'll show it a little bit. When it has underperformed for 1 year and definitely 2 years, it usually snaps up pretty quick. But I have two other big reasons. Number one, healthcare is a political football.
Mhm.
We just came out of a very contentious political season. And of course, healthcare was right in the crosshairs. Number two, because of the prior administration and because of interest rates, M&A was not even in first gear. It was at a
Mm.
snail's pace
Yeah.
because of either potential regulation or the cost of borrowing was so high. Typically, when M&A precipitously ticks up, the healthcare sector is absolutely one of the stalwarts there and could go up. So I believe because of those reasons, forget about new drugs, all this other great stuff. I think they'll do very well. I like defense also because we're not going to stop spending on defense. All
Mhm.
the hotspots in the world that we've been providing weapons all need to be restocked. This has actually been a great trade in the last year, and I think we'll continue doing well. I'll let you do consumer discretionary and I'll wrap up.
Yeah, consumer discretionary, I just feel like it yeah, I'm just not gonna bet against the consumer right now. The consumer is still powerful, is still going, even if the low end of the economy is struggling some. I think with tax regulation, reduced taxes, the upper end of the upper middle class to rich are spending money like it's gone out of style. They're spending money on vacations, they're spending money on cruises. I'm a big fan of the Royal Caribbean. I watch it very carefully and I listen to their conference calls.
Cruise lines have been taken off, no pun
Oh,
intended.
unreal.
Yeah,
And
or the
part of it was
cruising, how about that?
they did horrendously bad during the pandemic, of course, and I think some of that was a makeup, but I think that kind of package tourism and the bigger boats, the more choices that you have, that's just a really good example of, you know, how the consumer is continuing to spend on the top
Yeah.
end, and I don't really see that changing anytime soon.
I agree with you because that was my bonus sector.
Yep.
I only say watch. I don't have I have a conviction, but not a strong conviction for it for all the same reasons that you have. Because if those cracks do not widen next year, you're
Mhm.
100% correct. People are going to continue to spend
Yep.
and spend wisely. Now, I don't know about you, but I've gone to several business events and some dinners with friends, some dinners with clients. Now I know it's holiday season, but I'm going back to even the end of October. The restaurants are full.
Yep.
And I'm not a drinker when I go out, but the bars are full.
Mhm.
Before dinner, there are wine bottles on tables. Out here, it's get your Gatsby on, baby. It's animal
Yeah.
spirits. People are spending money, and I don't think they even give it. I don't even think they look at the check when it hits the table.
Yeah.
So I know this is different in certain areas, but people are spending. So that's why I agree with you.
Yeah.
Materials, I got to tell you, this would not have been one that came off the top of my head or through any research. I actually have been reading articles and looking at trending performance of certain sectors. And this has actually been a sector that has not only underperformed, but some of the market strategists that I follow really believe next year will be a good year for materials because of either infrastructure build or
Mhm.
for, as interest rates come down, expansion in the manufacturing sector. The material sector should do very well. So
Yeah.
I thought that was just, and also infrastructure too. So I thought that was pretty good. I don't know if you wanted to add anything to.
Yeah, I think it could be. It just wouldn't have been one of my top. I think it'll be in the middle
Yeah.
someplace. I think it will do better than it has been doing, but I don't think it's going to be one of the top sectors for this next year.
Okay. All right. So we have a couple of other interesting things. So here are now, of course, subject to change mid-year with these market strategies. So here we are of all the top. This isn't all, but this is all the top banks money centers, market strategists, the average is 67.21, which is
Mm.
the top end of my average and around your base case. I thought this was pretty interesting because I couldn't find the slide. I should have done a little more research into. We did this last year, and I believe the average high end was it was 6,500 by the
Mm.
end of, I'm sorry, 6,100 for
Okay.
this before they increased it mid-year, which I hate when they do that.
No, you're right. Yeah. No,
Some
you're
of them
totally
increased it
wrong.
twice this year. They
Yeah.
increased it April, May, and they did it again in September and October. And I'm
Look
thinking to
how
myself,
we
listen, I
were.
know data changes. We're not dumb and
At
stupid,
least you
but
and I are willing to admit our failures and say, you know what? Hey, I totally underestimated what.
they got to keep in there. Look, 'cause some of these annos, I'm sure they might have been getting cow prodded by their, hey, you better increase the price target. You keep your
Mhm.
price target where they're at. People might not put their money on the sideline in there. You always know that Chinese wall does not exist. I never believed in it. People are whispering in each other's ears like, hey, we got to get in the news. If you increase your price target, people are going to bring our money here because of all of your bookcase. Now, we
Mhm.
said this a million times. I've said it a few times. I say it in most of my client meetings. I can give you 10 reasons, 10 good reasons why the market is near all-time highs.
Mhm.
But you and I can give them 100 reasons why it should be 10 to 20% lower,
Yeah.
right? And
Yep.
it's not because we're perma bears. It's not because we just don't want to admit it. These are, there's a legit reasons. So we'll see. But I don't know if there was anything that stood out to you here.
What stands out to me most is Wells Fargo, 7,007. How did you come up with that idiotic number?
It had
7,007,
to be different.
because it was at 7,006, and we don't think it's going to go as high as 7,008. So it's 7,007. It's funny because we know somewhere mid-year, if we have a hell of a good year, they're going to pull the same BS that they've been pulling for the last several years. Oh, look how close we were at the end of the year. Yeah, because you changed it 3 times during the year. You know what? Take your lumps and say, I don't think it got that far. I
Too. These are the group. This group of people, though, are also saying 14 to 15% increase in earnings next year.
Yeah,
That's how they're aggregating a lot of these
sure.
numbers.
Yeah,
That's aggressive.
yeah, it's
It's
very
going to
aggressive.
take a year for them to do any, and despite the fact they have all three branches, it's going to
Mm.
take them a year. Nothing happens fast in Washington,
Nope.
even when they have all three. It's going to take us. So that means any real policy changes isn't going to happen in 2026.
Mhm. Yeah. Yeah, yes, I think it is. I think some of it is just straight up animal spirit. People feel like we're turning a corner, whatever it is, I don't know. A lot of it's gonna depend on if the whole media thing goes crazy like they usually do. I don't know. It's just there's something that's a different feeling to me right
Yeah.
now, and it's not because I'm a conservative or whatever. It's just there's a different feeling in the country, a
Yeah.
little less hopelessness than I think I've felt in a long time. And that's not just me. I'm just saying
Yeah.
it just feels like there's a little less hopelessness. Something that I maybe it's something weird or whatever, but the interesting thing is the best selling book this year on Amazon is the Bible. I don't get it.
Uh,
I don't get it. I'm not saying this from being religious or anything like that. I'm just saying there's something about the hope that people feel
yeah.
that we're an amazing country when we're all, or most of us, are pulling in the right direction.
And I'm a centrist and I have
Yeah.
clients on both sides.
Yep.
The ones that, let's just say, did not vote for the current administration, they feel like their portfolios will do well, but the
Yeah.
country's not going to get better.
Yeah.
Now, obviously, it would have been the reverse of that if it went
Mm,
the other way. But
yeah.
at the end of the day, you got to stay focused on the future and
Yeah.
you still got to wake up in the morning. All right.
Well, yeah. What I'm hoping is we finally get through this like completely separate. Everybody is out for themselves and their own ideals. And hopefully we can start to agree on some stuff.
Hopefully, we become less polarized. I
Yeah,
hear what you're saying.
exactly.
All right. So I thought this was interesting. I just wanted to go through this quickly. I believe I got this off of, yeah, it's off of Bloomberg, off their
Okay.
website.
Yep.
This is interesting. So the blue line is the strategist price target
Okay.
forecast, and the orange line, I love this color combination, is the market. So you
Okay.
can see over time, and this, the one main thing I wanted to point out was the end of 2021.
Yeah.
Because the end of 2021, this was 3 straight years of double-digit gain, and look
Mm.
where the strategists were.
Yeah.
They were that far above it, and of course, we were down. Of course, they all recalibrated by the end of the year, right? So, I just find this to be interesting because this is just media fodder,
Yep.
and it's frustrating, but obviously, we gotta talk about it.
Mm.
This was very quickly PE ratios, which I'm a big PEG ratio, PEG, price
Mm.
earnings to growth expectations. I
Yeah.
think that's a great indicator of buy sell signals with a lot of companies. And here we are, we're the highest since October 2020.
Mm.
But even if you just go back, now this isn't any indicator of anything other than, hey, maybe we're a little overvalued. Because the last time we were up this level, we pulled back
Mm.
22%.
Yeah.
Not that we couldn't go up another 5-10% here, but I think this is just very interesting. I think we are not in that area on the low end or breaching that area of potentially overvalued.
Mm.
What are your thoughts?
So here's the other side of that. You have the price side, but you have the earnings side. So if the estimates are right of, let's say,
Oh, yeah.
14% earnings,
Yeah, we could be up here.
it could not necessarily, it could go down because you have earnings up and prices not necessarily go up as much. It could be that, or it could just continue to ride along the path that it's on right now.
But I also heard something very interesting. If our dollar continues to rise against
Yeah.
other currency, we may get a 14 to 15% increase in earnings based on the US dollar, but
Mhm.
net will be less because of all the multinational
Yep.
businesses. They're not going to have 14 to 15% upside because of currency risk.
And that makes the case for small to mid-sized companies because they tend not to be as
They're more
global
domestic.
in those cases. They have underperformed significantly in this last year, really last 3 years. You've seen small to mid-sized companies massively underperform. So I think there's a case to say that we could see more growth, and the model that I use keeps flagging small to mid caps as the place to be. It's been a not so good trade this last 4 to 5 months because it's just like fits and starts. It does well, and then something happens, like yesterday, the Fed chairman saying, "We're going to be cautious." And then, of course, the market goes and blows up.
I hear you. All right. This is one of my favorites. I look at this probably every quarter,
Mhm.
definitely at the end of the year.
Yeah.
And this really, in my opinion, gives you the DNA of the market.
Yeah.
Look at it year by year. And just to prove my point, this is energy. It,
Mm. Yep.
it's just an underperform. Now, yes, was it up in 21, 22? Yeah. But
Mm.
if you're looking at a 5 to a 10-year investable timeline, why would you go into energy? And I prove this to clients, in charts every single year. Uh,
Mm.
but if you take a look, right? Healthcare last year, healthcare this year,
Mm.
political football. That's why I'm looking at upside. How often do you see utilities up here, right? It doesn't
Mm.
happen that often. They're usually in the bottom half.
And usually the only time that they do really well like this is when you reach a peak interest rate and then interest rates start coming down because they pay dividends. And that's typically the only reason that they go up at that point, or that they're up towards the top.
Yeah, and I know technology was a big sector for you next year. And,
Yep.
typically in down or sluggish years, technology is always sluggish. But if the
Mhm.
market is typically up 70 to 75% of the time, the technology sector is going to be in the top third, top half every
Mhm.
single year for those years. I
Yeah.
don't think there's going to be one year the market is going to be up, double digit. That information technology is not going to be in the top third, top half.
Yep.
And of course, real estate, for as good of a year as it's had the last couple of years, it's still in the bottom half in performers.
Mhm.
So this is one of my favorite charts.
Yeah, I always love this one because like I said, you can make the case visually for people when we're going to start drill baby drilling, and that means energy should do well, and it's not so much.
Well, here's the crazy thing about last year. because you can't lie with facts, right? You can twist facts, but you can't lie with facts. Last year, 70% of the S&P 500 move to the upside was by the top 10 stocks.
Yep.
To prove that point, last year, information technology was up 57.8%.
Mm-hmm.
You had two sectors negative.
Yeah.
So there was no breadth last year. The breadth came back this year. We saw that more in the second half than the first half. But even so, this is why you need to be diversified. Unless your horizon line is 10, 20 years out, you can stay in the momentum stuff, but you got to be diversified.
And I think if you look at some of those numbers too, the S&P 500, the white piece there, up 22%. The problem is that now information technology of the S&P 500, information technology is 40 or 50% or about 35% of the index now. So what happens with information technology affects almost everything else.
Here's the crazy thing too. Just look at the bottom here, because this is just aggregating the information for 15 years.
Yeah.
So it takes a look, the average on the annual, the best year and the worst year, right?
Mm.
So obviously, technology over the last 15 years on average has been up 21%, which is just a sick number in general,
Good.
right? You
Yeah.
got healthcare on average has been up 13.6, and you got consumer discretionary 16.79.
Mm.
But on average, if you just take a look at all the average, if you just invested in the S&P 500, you would have performed better than more than half of the average sectors,
Mm.
or half of the sectors with their performance each year.
Yeah.
Just invested in just the index itself. Something to think about when you're looking to put everything together.
Yeah. Awesome. I think I'm comfortable with my best guesses for next year. I
Yeah.
guess is the best way to put it. The predictions, I think we will have a good year. I think it's not going to just necessarily be straight up. I think it could be a little bit all over the fence a little bit this next year, because with whenever the Fed decides they want to drop interest rates, we know that they're probably only going to do two this next year. That's
Well,
gone
that's
down.
what they said.
Yeah, that's gone down from 4 earlier this year that they said. Who knows? I think the Fed chairman saying they're cautious about this. I think they've got to see what, the new administration's policies are and everything else, and how that's having an effect on inflation and employment and everything else. I would say I would expect more if we start to see employment start to implode a little bit going into this next year.
And the one thing that did come out in the press conference yesterday, and a lot of the market strategists have been saying it for a while, but now you're hearing it from the Fed. What did they say? The labor market has been cooling.
Mhm.
Doesn't mean it's been getting horrible or worse.
Yep.
Cooling means it's not as hot. It's been
Mhm.
stagnant. It's been slightly ticking up, meaning it's trending in the wrong direction, but
Yeah,
there's no precipitous jumps.
sure. Yeah. And we've seen a couple of inflation numbers spike up a little bit, but nothing to go, oh my God, it's
Correct.
ridiculously off the charts numbers. I would expect for them to be quiet for a pretty good chunk of next year. Maybe in the later half of the year, we'll see some interest rate cuts once they get a handle on
Yeah,
the new
this
policy.
is recorded. We're on record. It's got to come back.
That's fine. Come back, whatever. I don't know.
Well, you know what? We'll revisit it again in July or June.
Well, when we adjust our price targets up in July or June for, the rest of the year at that point. Folks, thank you for joining us. Thank you for watching over the last couple years. This is show number 85 that we're finishing 2024 with. We have had just a blast doing the show. Ron, I love him like a brother, so it gives me an excuse to talk to him every week anyhow. And you just get to hear our conversations and hopefully participate in, which means make sure you subscribe to the channel, give us an upvote, and give us some comments. You guys have been fun. I've been having some back and forth comments, back and forth with you guys online, and really having a good time with that. So thanks a lot. We'll see you in 2025. And of course, our predictions are going to be absolutely correct for next year.